positive upgrade to our net liquidity forecast. If you recall, we were somewhere down here. But then we got the debt. We did a little bit more research on understanding some of the debt ceiling dynamics, and then saw some of the cash management techniques that Janet Yellen was implementing. And we ultimately realized that, hey, look, it's probably going to flatter net liquidity, at least in the first quarter of this year, perhaps through the second quarter of this year. And that's exactly what we're talking about. It's happening through two channels: declining Treasury General account, and number two, increased T-bill issuance. So obviously, declining Treasury General account adds liquidity back to the real economy, liquidity that was taken from the real economy in the context of the Treasury Department raising cash and parking it with the Fed. The increased T-bill issuance, as you can see, has really improved the negative spread we've seen between T-bill yields and similar maturity money market rates. And as that negative spread compresses back towards zero, it means that there's enough ample supply of T-bills in terms of the shadow banks who can find those T-bills and use it as collateral to lever up and invest in capital markets. And so that's why you're seeing the reverse repo facility balance starting to tick down. I don't think it's going to collapse, because again, it's still one of the highest yields out there from a short-term cash management perspective in terms of money markets and their availability of instruments to park capital in. But I do believe it's could gradually decline, and the confluence of those two things gradually declining may offset quantitative tightening, throughout the first half of this year. And ultimately, that's a positive dynamic relative to a marketplace that is very clearly focused. I think the less informed, the less macro aware investors are just focused on $95 billion a month of QT. And that's just clearly not the only thing that matters from a dollar net liquidity standpoint. So hopefully everyone understands those and appreciates these dynamics, because it is meaningful. It's meaningful in the sense that A, it's happening, but B, it's also happening in the context of China reopening and stimulating. And so it's like a 1-2 punch relative to all that bearish positioning that we continue to observe in our positioning model, which we'll talk about in a few slides. Our right tail risk scenario has ample scope to continue getting priced in, because ultimately dispersion on a trending basis has been defensive. So this breakout in cyclicals is new, is what I'm effectively saying. And so ultimately it means, we can go from, -2 sigma in terms of defensive leadership, and it's negative in this chart here, this time series of dispersion. It just means defensives are leading to a +2 sigma. Are we going to +2 sigma? I have no idea. But if the dispersion, if this rate tail risk scenario gets priced in through March, you could get up to the +2 sigma. Certainly, I think you would if they got priced in all the way through June, because again, net liquidity is being flattered by some of these dynamics, the debt ceiling debate, which ultimately I think is going to be a problem. We talked about that in the leadoff morning note a couple of weeks ago. It's going to be a problem, but again, it's not a problem today. If anything, it's a boon to asset markets today. From a positioning perspective, we talked about this. The Goldilocks pain trade may persist amid moderately favorable 42 macro net liquidity dynamics. So again, S&P 500 -7% net short position in terms of non-commercial net length as a percent of total open interest. Long Treasury bonds -14% net short. Investors are still leaning quite short here. The fundamentalists are fighting this move.